I'm Kose John from the Stern School NYU. I want to invite you all to the session on recent fintech research on Bitcoin and other crypto assets. The first thing we're going to do is to have Itay Goldstein from the Wharton School sort of talk about new directions in research on blockchain and cryptocurrencies. Itay?
So how do I? Okay, thank you, Kos, and thank you, Julapa. Julapa asked me to give a short overview for 10 minutes or so about the current trends in research on blockchain and cryptocurrencies. So this is what I'll do. I will say that most of my exposure to it is coming through my role as an editor at the Review of Financial Studies. So I will start by talking about this, and then try to classify the research in blockchain and cryptocurrencies into three main branches where I think things are going right now, and give a couple of examples on each one of them of some of the work that has been done, and then summarize. So in 2016, there was very little academic research on fintech, including blockchain, cryptocurrencies, and ICOs. As the editor's team at the time in the Review of Financial Studies, we said, well, how come this is such a hot area in the industry and you don't have academic research? So we introduced this Fintech Initiative at the RFS, where we basically had a call for proposals and went around and asked people to submit proposals on what kind of research they could do on fintech, including blockchain and cryptocurrencies and ICOs. We received 156 proposals. We had a novel editorial process that led to a special issue that came out in May a few months ago with 10 papers that I think are providing good guidance for the future on the research for fintech. I think when you look at things right now in terms of the academic research on fintech, and in particular blockchain, cryptocurrencies, and ICOs, which is the topic of this panel, I don't think we have a problem of scarcity of research anymore. I think we have quite a few papers out there and a lot more that is developing. One might wonder if the field went too far. Maybe we have even too much. I'm not going to say that. But I don't think scarcity is the problem. We had a couple of follow-up conferences in the RFS around fintech. We have a constant flow of submissions on the topic. And I think it is certainly developing into a very fruitful research area. So what I thought I'll do here is to give you a glimpse into what's being done now in the frontier. And as I said, I will try to summarize this the way I see it as developing in three different branches. Each one of them has its own type of questions and style of work. The first one, and we have two papers on the panel that I think belong into this branch of work, is about the blockchain protocol, where people are basically trying to identify issues with the design of the blockchain protocol and potential inefficiencies in this design, and how these affect the viability of the trading process and some of the consequences of the trading process. I think it's fair to say that generally speaking, the research in this branch of work is kind of at the intersection of finance and computer science. You do have some collaborations between finance and computer science, but even if not, I think the issues really speak to both fields. And I've put here on the slide a few examples. These are just examples because you have more papers than what's here. But just to give a flavor of what's been done, there's a paper by BA and others that basically talks about how coordination problems could emerge in the blockchain process, potentially disrupting the convergence and leading to multiple equilibria. You have a paper by Isley, O'Hara, and Basu talking about transaction fees in Bitcoin. Fahed here has a paper on alternative protocols exploring their viability as opposed to the traditional Bitcoin one. There are papers on the mining process, the incentives for miners, and how this works out in equilibrium. And as I mentioned, a couple papers on this panel I think will fall into this category, the one that Fahed will present, and also the one by Christine. Okay. The second line of work on blockchain, cryptocurrencies, and ICOs looks at something very different, kind of taking as given the protocol and what happens behind the scenes in the blockchain world, and asking what will be the effect of all these blockchain processes on the real economy, on transactions and contracts that we see in the real economy. And really trying to understand whether all these blockchain developments are going to have a real impact on the way that corporations work, on the way that the equilibrium works in industrial organization, on production, on hiring, on contracts, and so on. And in general, this line of research builds very heavily on things that people have done for years in corporate finance and industrial organization, and trying to ask whether those developments in blockchain and cryptocurrency are going to make a big difference in the way that corporate finance and industrial organization work. So here, again, just a few examples, and I'll put a plug at the end to a recent paper that I have on this as well. But there is a paper by Will Kong and Jigo He that talk about how smart contracts affect firms' interactions in the industry, to what extent these are good or bad. An empirical paper by David Yermak and others looking at ICOs and real outcomes, kind of trying to analyze what is the effect of ICOs on the real outcomes of firms that have issued them. There are papers talking about the coordination in platform adoption and how those coins could potentially affect the coordination and help the coordination evolve. There are papers that talk about how ICOs could help in incentivizing entrepreneurs. So if you think about security design and how you design securities in a way to affect the incentive of entrepreneurs, ICOs basically opens a new range of possibilities. And as I mentioned, a recent paper that we have with a recent graduate from Wharton and a current PhD student from Wharton, we basically talk about the fact that ICOs could provide a commitment to entrepreneurs to operate platforms competitively, and this is what gives justification for their existence in equilibrium. Finally, the last line of work in cryptocurrencies, ICOs, and blockchain looks at yet another perspective, which is the asset market properties of cryptocurrencies. So here, basically, the idea is to think about cryptocurrency as a new type of asset, as a new asset class, and think about what do we know about this asset class from an asset pricing perspective. How do they fit into investment portfolios? How should people build portfolios when cryptocurrencies also exist? And there is one paper by Andrei on the panel that I would classify into this category. In general, the research here builds on asset pricing and monetary economics. Some recent examples, a paper by Liu and Savinsky talks about empirical patterns in risk and return of cryptocurrencies, kind of taking traditional methods in asset pricing and seeing how they fit into the analysis of cryptocurrency. A paper by Kong, Li, and Wang that talks about the feedback between users' adoption and cryptocurrency price and trying to explain all sorts of patterns in cryptocurrency price using that. And a paper by Schilling and Ullig that talks about the interaction between fiat money and cryptocurrency, and how we can use that to understand, again, more broadly, patterns in asset pricing of cryptocurrency. Okay? So just have a couple minutes, so let me briefly conclude. So as I said, I think the economic research on blockchain, cryptocurrencies, and ICOs is thriving. It's very obvious when you look at the volume of papers out there and conferences and general interest in this area. I was trying to classify the existing research and the research in the frontier into three types of work. And as you could see, I think they build on existing fields and enrich them in very nice ways. So they build on computer science, corporate finance, industrial organization, asset pricing, and monetary economics. One thing to say is that there is a good mix of theory and empirical work in the current research on blockchain. A lot of theoretical research really trying to understand how these mechanisms work, but also empirical research emerging with the new data. And I think overall there are many good reasons to think that this trend will continue and be supported by robust real-world activity. For example, one motivating fact that we use in our paper is that in 2016 you had 52 ICO collectively raising about $283 million, whereas in 2018, 2 years later, already 3,800 ICOs raising close to $30 billion and kind of reaching the levels of the IPO market in that year. So, robust real-world activity will certainly help the development of research in this space. But if I would close with a word of caution, I would say that, as academics, we probably want to look around and ask more about the viability of these instruments going forward. I think there are quite a few uncertainties. Regulatory uncertainty, I know, is something that many people here are talking about and will come up in panels. But certainly holding these things behind. So we don't want to get ahead of ourselves, and we want to make sure that these things will continue to exist as we produce all this research. Okay, thank you.
Thank you, Itay. Okay, now we're going to proceed to the papers. We have 3 great papers and 3 excellent discussants. So I want to make sure everybody gets their time. So we're going to have 18-minute presentations and 8-minute discussions. And I've been known to be ruthless with respect to time. Okay, the first paper is Miner Collusion and the Bitcoin Protocol. Christine Parlour from Berkeley is going to present it.
Thank you. Thank you. I'm not sure whether or not this should be called minor collusion or minor collusion with an O, but you can make your decision. So the reason why we wrote this paper is because a lot of people have been talking about decentralized finance, or DeFi, so people like these sort of acronyms. And essentially our question is, should we expect these kinds of new decentralized systems to be more efficient than traditional intermediaries? And in particular, we're going to focus on one arguably very successful use case, which is Bitcoin as a settlement system. And essentially, we just want to say, okay, has Bitcoin actually delivered on the promise, which is to provide, in a decentralized way, settlement services at a minimal cost to individuals? Their social costs, pollution, whatnot, but at a minimal cost to individuals. And so what we do is, it's primarily empirical. We basically look at all blocks. So it's publicly available. We look at all blocks between January the 3rd, 2009, November 14, 2018, that's sort of when we stopped analyzing it. And for each block, we just go through all the information in it. You see the Coinbase, which is the thing that's generated automatically by the code that goes to the successful miner who mines the block. This was originally set at 50 Bitcoin, and it's cut in half every 210,000 transactions. And we look at every single transaction in the block. And so transactions have 2 bits. They have a bit that says, okay, I'm moving it from this wallet to this wallet. And what's interesting about transactions is that sometimes the amount that you're taking out of one wallet differs from the amount that you're putting into the destination wallet. The difference between those 2 things are called fees, And these are fees that people pay to miners, presumably as an incentive to have their transaction put into the blockchain earlier. So this is the argument. And so our focus is going to be on these fees, and just to think about them. Because when we argue about traditional intermediaries, there's this discussion about the fact that they extract rents, they make too much profit, and so we're trying to understand this in the context of the Bitcoin blockchain. And there are two ways in which miners get paid. One is through the code. This is just these automatic Bitcoin that get assigned to them. This is for finding the nonce. This is called a Coinbase. And in addition, these fees. And what do we find? We find, when we look through every single block and every single transaction, we find that there's excess capacity in mined blocks. Usually we think about fees as being charged if there's some sort of capacity constraint and people want to bid to basically get in the door. We find that there appears to be excess capacity. We also find that there's massive heterogeneity in the fees that are paid to miners. Some people pay nothing, some people pay in excess of $10,000. When we think about it economically, it seems that this kind of excess capacity is strategic, and we argue that it's consistent with what economists call price discrimination. So in particular, we're thinking of miners and subsequently mining pools as essentially manipulating the capacity in the blockchain to get people to bid higher so they make more money. And when we do that thought experiment, we sort of look at the data and we come up with a number of 200 million a year that the mining pools have extracted with this strategy. And we say mining pools because when economists think about sustaining things different from competitive equilibrium, we think that if there are fewer people participating, it's easier to get these schemes going. And mining pools, in as much as they represent concentrations of interest, are ways to get these schemes going. And so that's where the 200 million comes from. Okay, so the reason why this is sort of interesting from an academic point of view is because a lot of the literature on fees and the fees that people pay to be settled sort of assume that there's a capacity constraint on the blockchain, right? They assume that basically people have to pay to get in the door. And so the literature up to this point has sort of made this argument, and this is the thing that we're kind of going against. So there is a capacity constraint on the blockchain, and it is finite, right? Every block has a certain amount of bytes in transaction computer size that can be processed. Over time, this capacity has changed. Some of the details are a little bit hairy and computer science-like. So there was something, for example, called the SegWit, or segregated witness. It sounds like something out of, I don't know, Lord of the Rings or something. Oh, the SegWit. This apparently increased the capacity of the block. Not all wallets are SegWit compliant, so there's something called a weight of a transaction. It's just a whole bunch of mumbo jumbo. Basically, just sort of think about it, there's a capacity constraint, right? So what is this picture? This basically gives from the beginning of our sample to the end of our sample, number of blocks and fraction of all empty and full blocks per day. So on every day, we take an average of these things. And the green line basically gives you the fraction of empty blocks. So when it first started, there was sort of not very much going on, so nobody knew about Bitcoin, so there was empty. Over time, this basically goes down, down, down to pretty close to zero. The red is the fraction of full blocks, right? The orange is basically the average capacity use on any given day. Right? So it doesn't appear to be flat at 1. It's not 100% used. It varies over time, but there is excess capacity. So two types of excess capacity we see. One, they're blocks that are just flat out empty. Right? So I don't know if you remember the bubble, the drama. Bitcoin was trading at a ridiculously high amount. On that day, when it peaked, one particular mining pool mined 2 empty blocks. Right? No transactions were in it, they just mined. Right? On the same day, the same pool also mined some blocks that had transactions in them. So we don't think it's a technical thing. We think it's just they're choosing not to actually put transactions into the block. Right? The other thing that we see is we see partially filled blocks. So some blocks have, half capacity left. They have more capacity, less capacity, varies over time, but not filled up at all. And to put this sort of in numbers, or why this is surprising, be aware that through all this time when blocks are not full, there are fees that are sitting there that could be basically taken by the miners. So this picture basically gives you the fraction of zero fee transactions. So the beginning of Bitcoin, not a lot of fees, and then basically everyone is paying fees. And the red line basically gives you a number of transactions. Right? We get information from the mempool, which is essentially the transactions who haven't been processed that are sitting around and waiting. We got some guy who's running a node to give us the data. And basically what we do is we say, okay, for any given block, we can see the transactions that haven't gone through. We can go and see timestamp it to essentially the pools that are sitting there waiting to be transacted. And we can say, okay, given how much space was left in the block, how much more money could these guys have made if they'd scooped up some of these fee-paying clients? And essentially what this does is it shows you daily money left on the table. Okay? So it's not huge, but it's not zero. The other thing that we notice is that there's huge cross-sectional variation in fees. So these graphs just get a little bit squiggly after a while. Take my word for it. Huge cross-sectional variation. In terms of numbers, there are transactions on, say, peak periods that are over $10,000. Some transactions go through the blockchain with zero fees attached at the same time. Think about any banking services where the fee spread is between 0 and 10,000 for exactly the same thing. It would be difficult to see exactly what that service would be legally. Right? This is surprising. It's surprising because these fees are actually non-negligible. And what this information gives you is that essentially it represents fees as a proportion of the base payoff that miners get for participating in this market. Right? And essentially on the axis over there, you see between 0 and 1, so 0 and 100%. And the red line basically tells you how much the fees are as a proportion of the coin base. And these are just the median fees for blocks. So this is sort of a way lower estimate of how much money they're actually getting. Okay? So how do we want to think about this? Well, if you think about it, and you want to get a transaction to go through, and you think that there might be some sort of capacity constraint, like any reasonable person, you're going to bid. Okay? How do we want to think about bidding for this system? Well, if you put a bid into a usual auction, there's a specific protocol that people have to follow. The highest bid goes first, and whoever wins, whoever has the highest price wins. Right? When you think about the Bitcoin blockchain protocol, this is not the case. It's not the case because the miners can pick whichever transactions they want. So what we do is we build a very simple model that's got two types of people who want to get their transaction processed. One, somebody who sort of wants to get it processed and has a pretty low cost of waiting. Somebody else who really wants to get their transaction through and has a very, very high cost of waiting. And so just to sort of think through how we're thinking about it, think about people arriving, think about the person who's organizing the blockchain, whoever that might be, transacting or picking the orders. Then think about the memory pool being flushed and the whole thing repeating again and again and again. Realistically, when you put an order in or you want to post a transaction to the blockchain, you can't cancel, right? Once it's in, you just have to wait around for it. You have to sit and wait around for it to go through. And so this is why we're organizing it the way we are. Can I just, as a word of caution to the next group, the clock is not moving forward. 5 minutes. Oh, thank you very much. It's a bit disorienting. I'm speaking really quickly because time is not moving. Okay. All right.
Stuck in the mempool.
That's right. So what do? So we take this model and we do the sort of usual things that you do with models. We sort of spend a lot of time scratching around. And essentially we think about two different types of rationing or settlement rules. One, we say, okay, what would the world look like if what the servicers did is basically take every single transaction, starting at the highest price first, and transacting going through like this? What's going to happen? Well, if you're really, really desperate, and you know that they're always going to take the highest transaction first, what you're going to do is you're just going to bid just a little bit above the guy who's not so desperate. What that says is that if you have a highest price first priority, the guy who's super desperate essentially can bid just a little bit higher than the guy who is not desperate at all. And this guy retains rents, he gets a good deal, he really likes the blockchain. Right? We call that competitive servicing. The other thing that you could think about is you could think about a situation when the servicers or the miners basically selectively pick transactions. And what a miner could do is say, you know what, if you're not bidding really, really high, like really high, I might not take you. So instead of just bidding slightly higher than the people who are sort of, all right, they're happy to be in the Bitcoin system but not desperate, right? Somebody who's desperate in a world in which there's this discriminatory pricing is going to bid really, really aggressively. So what you're going to see is you're going to see a difference between prices between these two sorts of servicing protocols. And if the miners are discriminating, essentially they're doing it, or one result of them doing it is that people are going to bid much, much more aggressively, and they're going to have way bigger fees to take home. Okay? So, if they're strategically manipulating capacity, which we think they are, they're doing it to increase the maximum bids, right? To make more money. And there are a whole bunch of implications that flow from this. One implication is that if you have mining pools, it's much, much easier to do this. Right? It's much easier to do it because if you want to have a funky pricing strategy, it's much easier to sustain it if there are fewer people who are coordinating on that strategy. In addition, systematically we see in blocks, miners actually signing the blocks that they process. And if they're in a world where we have these people who are kind of keeping an eye on what everyone else is doing, they're saying, hey, I just mined this block, look at it. And this is sort of a way of transmitting information, essentially about this pricing strategy. Okay? So I think I'm probably getting close to 3 minutes. Okay. So let me, we do regressions. Everyone does regressions. So let me come to this sort of the bottom line. What is the economic cost of this? We've got a little model that basically says, you know, if they just committed to go highest price first, people would bid a little bit lower, right? because they can pick and choose who to execute, yes or no, some people bid very, very aggressively because they're worried about their transaction not going through. So what we can do is we can sort of say economically, how much money have they made by manipulating this capacity? And through sort of usual econometric mumbo-jumbo, what we do is we look at the distribution of bids, and we basically say, okay, which ones are higher than they would have been if they'd actually done a highest price first protocol. And the number that we come up with is 557, 568, 542, and 21 cents. I don't know if we had to have the 21 cents, but that's the number. Okay. So conclusion. Under the Bitcoin protocol, there is no constraint on the miners as to which transactions they put through. It's not part of the system, right? There appears to be consistently unused capacity, even when you have transactions that are fee-paying sitting around in the mempool. Okay? The relationship that we see between this strategic capacity generation, if you will, and fee structures is consistent with what we call price discrimination, and mining pools are a way of facilitating this. And this, for an economist, this is really interesting, because this is an organic, essentially fee-extracting machine that just arose by people sort of having incentives and living outside the regulatory universe. So it's something that we find very interesting. Thank you.
Thank you, Christine. Asani Sarkar from New York Fed is going to discuss the paper.
This one? Okay. Well, thank you very much. Thank you, Julapa, for inviting me. This is the second time I'm coming to the conference, and really impressed by the consistent quality of the agenda that you always put forward. So I have to, since I'm from the Federal Reserve Bank of New York, I have to start with this disclaimer. These views are mine. It doesn't reflect the views of either the Federal Reserve Bank of New York or the Federal Reserve System. So it was, reading this paper and discussing has been a really educational experience for me. Essentially, when I started reading this paper, I knew epsilon about the mining ecosystem, epsilon tiny. And then after discussing this paper, I know twice epsilon, so I know a little bit more. But I do think it's an important contribution, because it really strikes at the heart of what is the potential benefit or the proposed benefit of Bitcoin, which is this aspect that is a decentralized system. It's a fascinating paper, and I encourage everyone to read it who's interested in this topic. So what I want to do is start by talking a little bit, placing this in slightly broader context, talking about why this topic is important and why the contribution is important, and I'll go into a little bit of more detailed comments. So why do we care about frictions and transaction costs? So going back to Bitcoin and crypto, you can either think of it as an asset on which you speculate, or as a medium of exchange for payments. So whichever the rationale, frictions are really important, because if you have frictions, then it decreases the value of both of these functions. So if we think about, originally when Bitcoin came in, it was touted as a frictionless system, as opposed to the traditional financial system. But through research, we now know that there are actually two broad sources of friction. So one source is the fact that there has to be, because Bitcoin itself is not widely used as a means of payment, you have to exchange it for fiat money. And that leads to some frictions. And this diagram kind of talks about that. So essentially, suppose you're you're doing a Bitcoin arbitrage, right? So essentially what you would do is you would start off with some currency, you would have to deposit in an exchange, buy in one Bitcoin exchange, sell it in another, and take it out, right? So the whole system is kind of sitting on this money transfer system, and there's sort of delays and costs involved in it. That could be potentially significant. For example, with Libra, some estimates say that about 2 to 3% of total value could be lost at both of these ends. Another source of friction is within the Bitcoin system, and this has to do with the complexity of the Bitcoin protocol and generally the ecosystem in general. And the issues here are issues of capacity constraints, mining, and transaction fees. So let's get into that a little bit. So as Christine said, the miners, who are essentially the heart of the system because they validate the transaction, they can be either paid in Bitcoin, and the way the protocol goes is that reward goes down towards zero. In about 100-something years, it'll go to exactly zero. Now, the caveat there is actually the value of the reward actually depends on the price of the Bitcoin. So it's possible if the price is very, very high, that reward could still be significant. But more and more what's been happening is the transaction fees, which is actually paid by the users. So that's different from the rewards, which is fixed into the protocol. And so this graph, which is from Easley, O'Hara, and Basu, and they're showing that the share of miners' revenue, which is coming from transaction fees, is getting higher and higher. So this aspect, which Christine is talking about, is very important. Okay, so in the current literature, the view is that because of this fixed protocol and these high transaction fees, the Bitcoin system may be non-viable. Okay, and so in these papers, they think of miners as competitive and as price takers. So there's free entry, so they have zero expected profits. So when there's high demand, there's congestion in the system, so you kind of have this queuing problem you have to solve. And so in equilibrium, you will have a positive transaction fee and equilibrium waiting time, because essentially, because it's congestion, to have your transaction mined, you have to pay something, okay? So the concern in the literature was either that fees are too low, which makes mining unprofitable, or fees are too high, which discourage users, okay? And alternatively, if this happens, there's it could migrate to traditional payment system, as in the paper that we'll see later on by Hinz, John, and Saleh. Now, this paper is actually proposing something quite different. So they're saying there's a ceiling, the capacity is finite, but actually it's an endogenous choice. And miners choose to not use some of these capacities and forego some of the fees. And the reason they do that is that it's actually optimal for them to discriminate among different users. And users which have very high immediacy, they charge them very high fees. But how is it possible if mining is competitive? Because miners are these, essentially like individuals. So the solution is that the reason that's possible is because you have these mining pools and they act collusively. And that's what makes this price discrimination possible, because it gives them a certain amount of monopoly power. So as I said before, this undermines this question of decentralization, but also I think, which Christine does mention in the paper, this actually also undermines the security of the Bitcoin system, which is another selling point. Okay, so I'm going to just a short summary, then talk a little bit about the dynamics of the mining pools, the incentive to collude, short slide on empirical results, and then conclude. Okay, so in terms of the model, essentially 3 minutes, okay. They start with this, with the empirical observation that there's this unused capacity and they leave money on the table, and this can be explained by this behavior that they price discriminate. Okay, so that leads to this rational equilibrium where they essentially commit to executing with probability 1 a bid with a very high transaction fee. And the way you sustain this collusion is that you punish any deviation by saying, okay, we'll go to this full capacity equilibrium forever. Okay, so first point is about the dynamics. So this is a paper by Kong, He, and Lee. So in this paper, what you see is that the mining pools are essentially all of the mining ecosystem, right? But what's interesting is that these different segments are these different mining pools. And what you see is over time, when the share of a particular mining pool is high, it eventually goes down. So there's kind of this mean reverting, okay? And the reason that they give in the paper is that it is true that the mining pool gets bigger, you can charge more fees. But what happens, you attract less users. So over time, dynamically, the monopoly power of a mining pool is self-limiting, okay? So in addition to that, they also mentioned there's no increasing returns to scale in cryptography, so there's sort of no technological reason why mining pools should be very large. And also this other aspect which is important, the individual miners can actually belong to many mining pools. So essentially, they can undo the power of the mining pool, this sort of a Modigliani-Miller type theorem. So that's point number one, that maybe this price discrimination can be temporary. Okay, so the second thing is, what are the incentives to actually collude for an actual mining pool? So mining pool, basically what it does is it actually sells insurance to individual miners, because individual miners, the upfront fees are very high. So essentially this, the mining pools have an interest in maximizing aggregate activity, right? Because that increases the diversification benefits. So is that consistent with rationing? Well, to answer that, if you look at the manager, the guy who's managing the pool, where is his profits coming from? His profits are coming from these rewards from mining the pools, and it's possible that, you know, if the pool manager price discriminates, the rewards are going to be high from transaction fees. So that is consistent with this idea that there would be some incentive to price discriminate. But I want to get to another point, and maybe this is the last point given the time, which is that these actually, the power in the mining ecosystem are these specialized manufacturers which manufacture these chips that you need to mining pools. Bitmain technology, for example, is a 75% market share. And these guys also own the mining pool. So they, in fact, own the two largest mining pools. And most of their revenue is actually coming from selling the equipment. So in fact, they have a very strong incentive to maximize the amount of activity instead of having a rationing type system. And this is actually a nice paper by Nicoloa, and who was showing this. So this is a potential thing that they have to address. So I think I'm just going to end there. And just in terms of empirical analysis, Christine didn't get a chance to show that. I'll just mention like two things. So one is they're basically trying to explain the fee, which makes sense from the model. But I think it would also be interesting to look at what the potential is for activity. The second thing I would suggest is that since these fees are heterogeneous, they might consider doing quantile regression. So essentially, in the quantile regression, instead of trying to explain the average fee, you essentially explain like the different percentiles of the fee distribution. So in other words, you have once you explain the high fees and the low fees, separately. And so the idea here would be the high fees would be determined, for example, by immediacy, whereas the low fees may not. So let me conclude saying that I really like this paper. I think it's an important contribution because it shows these new empirical facts about Bitcoin capacity and fees. It's a different view of the mining ecosystem that is not competitive, but there's price discrimination going on. So I guess two things to consider. One is from the modeling point of view, is this in fact a sustainable strategy in the long run? And from the empirics, a lot of the results are kind of suggestive, but I think there's sort of more discussion needed about ruling out alternative results. So thank you very much.
Thank you, Asani. All right, let's stick to time. The next paper is a model of the optimal selection of crypto assets. Andrei Kirilenko from University of Cambridge is going to present.
Thank you very much for having me here. I thank you, Jalapa, and thank you other organizers for having me here. Interesting conference. This is a joint work with Silvia Bartolucci, who is my postdoc at the Fintech Center that I started at Imperial. So what what I'd like to start with first is some definitions. And this picture here is basically illustrating partly what you heard in the previous session, which is those little circles are various transactions, and the squares in them as transactions are included would form blocks. And the way I'd like to describe what a crypto asset is that a crypto asset is an intangible digital asset whose issue and sale or transfer is secured by cryptography and shared electronically via distributed ledger, and distributed ledger itself is a database of issuance and transaction records. And each crypto asset has its own ledger and its own network of nodes that supports that. You've heard from the previous paper, and if you're familiar with it, what these terms are. It takes a little bit of getting used to, crypto assets, blockchain, nodes, and whatnot. But by now you're an educated audience. What does it mean? Why is it an intangible digital asset? Well, it doesn't have a physical substance, right? It's never had it. So that's what makes it intangible. It's digitally identifiable, meaning that it is identified as an asset. And it's held in expectation of future economic benefits. Under current standard, the crypto asset actually does not meet the definition of either cash or financial instrument because, interestingly, a crypto asset is an asset, but it's actually no one's liability. So it's we're here in the Federal Reserve, and the currency, for example, would be a liability of the central bank. It will be on the central bank's balance sheet. Notes and coins in circulation. Assets that we're more familiar with would be someone's liability. In this particular case, it's an interesting phenomenon. It's one of the interesting things about these crypto assets. There have been many assets issued. This is just one map from a while ago, from 2017. This is sort of an ecosystem. It's a publicly available image licensed under Creative Commons. That many of them have been issued. So there is sort of a multiplicity of these crypto assets. And there are sort of many different features and protocols and uses. This is from Autonomous Next. You see these crypto assets being used for in payments, in markets, and investments, in a variety of ways. And what we also know is that only a few of these are going to be adopted. This is from a paper by a couple of colleagues from Boston College. And what they've done is that they looked at initial coin offerings, and they looked at their Twitter following, and they designated those that did not have following on Twitter for over 60 days as dead, basically, because if no one follows you on Twitter, you're dead, right? So you don't exist anymore as an asset. So what we sort of have an idea about is that the successful adoption of crypto assets hinges on network effects. Please raise your hand if you use WhatsApp. Raise your hand. Okay. Please raise your hand if you use Viber. Please raise your hand if you use Telegram. So these are, in principle, very similar, very, very similar communication protocols, yet many of you use a number of them. I use all three. So in principle, we can ask, imagine for those of you who use WhatsApp, an easiest way to describe a crypto asset. Oh, please raise your hand and if you use smiley face. Use a smiley face? Okay. So imagine that smiley faces, when you're using these protocols on WhatsApp, are in actual limited supply, and you have to pay for them if you want to use them. And each one of them costs you something. You can't just go and use a smiley face. So then that smiley face is going to become valuable to you if you want to use it. You can, in principle, then sell it to someone, or you can sell a portion of a smiley face. Yeah, and so they could buy it from and other emojis. You can think of a number of other things. Please raise your hand if you use a thumbs up. Okay, so you can do a thumbs up, you can do a smiley face, I use this one a lot. When my wife asks me how your day is going, that one was a tongue sticking out, right? So, so imagine that each one of those is a crypto asset, and these platforms are sort of platforms that support them, right? So in principle, you can think of that the reason you're using that is because others are using that. You wouldn't be using that if others are not using it. And so the idea is that the successful adoption of this would depend on network effects, on how many others are using it. And in principle, you can also think of that another thing about this digitally native assets is that they're actually very easy to put, they're not very expensive to put together. They're very cheaply issued. So, and they're easily copied. And you can think of there could be potentially a number of them, just like there's WhatsApp and there's Viber and there's Telegram, there could be a number of them that are used at the same time, right? So you can think of several crypto assets with different protocols existing either in different jurisdictions or for different purposes. One of the interesting things about Telegram, for example, is you can have your own channel, right? So you can use it for that. Think of it as a smart contract equivalent, right? So you can have something that belongs to you that you can manage. So a number of these would potentially, so the majority of them will become little red crosses, but a number of them potentially could become the assets of the future. Why? Because what do we think of in finance as something that makes an asset an asset? As far as I know, we don't have a consensus theory of asset pricing. We price different assets using, price equity one way, price commodities another way, price fixed income another way. We have something that we sort of come up with, but it always boils down to something unobservable and stochastic, right? So, which is kind of like fate. And so in principle, there is in there that these assets, what's interesting about them is that they're global, they're digitally native, they run on computers, and Moore's law power computers. We know that it's, computing power is becoming cheaper. So some of them would be able to, store and transfer wealth of the future. As we discussed from the WhatsApp raising of hands, the network effects, and that's important, is a demand-side phenomena. Demand side. It's not a friction or transactions cost phenomena. It's not an informational phenomena. It's demand. If others are using it, you will have more of a reason to use it. There are externalities to you if more participants are on it. So it's a demand-side phenomena. And so what we want to think about it, and here I'm quoting here from Alderian from Google and Vitalik Buterin, one of the founders the founder of Ethereum, actually, is that they specifically identify network effects as being important. We can see why. So what we're doing in this paper is the following. We're asking sort of provocative questions. And the provocative questions are, should we think of our traditional ways that we apply to asset pricing straight up as a way to think about crypto assets? As I told you, if you had to buy, smiley faces to use on WhatsApp, what's the value of the smiley face? Should we think of it in the same way? It might well be, and I would hope that it is, that we actually do, as Itay said, end up building on existing foundations. But we don't necessarily want to start building on existing foundations. We want to actually challenge them. We want to see, well, why don't we challenge them? Is it always, should we always think the same way that investors are going to be making selections about, smiley faces or this in the same way that they make about stocks and bonds? Why? maybe there are other solutions to that. Should we always think of these, features of these intangible digital assets being valuable to investors in the same way that they made decisions before? Should we always think of, the supply of these assets, which assets are going to be supplied the same way as we thought of assets that were supplied before and how they were governed before? And so we're going to ask a few provocative questions here, because we want to think a little bit outside the box and present to you sort of a framework. So here's our framework. So our framework, first of all, it will have supply and demand. So on the supply side, we're going to think of a couple of attributes. Why two attributes? Because two attributes fit very well on a two-dimensional surface. So you can put them on the chart, right? But think of two attributes that are important on the supply side of crypto assets. All crypto assets could be characterized in the dimension of only two attributes. One of them is security, and security think of as technological vulnerability to manipulation, abuse, and attack. And the security is a cross-sectional attribute. There could be many different crypto assets, and they vary by security, right, at the point in time. And the other one is stability, and that is, over time, vulnerability related to potentially faulty governance. So for those of you who are familiar with crypto assets, think of security as a particular encryption protocol or hash function that's being used in there, and think of stability as a consensus mechanism. That is how, what is considered to be on the blockchain and under what consensus. It has a combination of both technological features and other features. So to make things a little bit more, I don't know, label-y, if you will, we actually identified some of these assets, and we just sort of called them names. And say, think of something that has high security and high stability as central bank digital currencies, and something with low security and low stability as crypto tokens. And then you can have cryptocurrencies and stable coins there on the map. So we are at the Federal Reserve Board, and let me illustrate a little bit to you what security versus stability means. And so security, think of various features that are embedded in the, let's say, $100 bill that make it very, very difficult to forge. And the stability is the Federal Reserve Board. The Federal Reserve System, all around it, all the various presidents that come together, and they form committees, and these committees meet on the sort of predictable basis. They have to have minutes, and they have staff working for them. That's stability, okay? So you can think of another way. This is the currency of Venezuela. Actually, the currency of Venezuela, in terms of its technological features, is actually quite sophisticated. But the Central Bank of Venezuela, which is the feature here, does not have the governance that the Federal Reserve System has, right? And so you can have something that is secure but not quite stable. You can have something that's secure and stable, less secure and more stable and whatnot. So the important part is the demand. So on the demand side, because remember the network effects come from the demand, right? So on the demand side, we're going to do something really quite exciting. On the demand side, what we're going to say is that based in principle, along the security and stability dimension, you can issue as many of these digitally native assets as you want. The important part is what is going to be the selection protocol? Why are some people going to be choosing WhatsApp, for example, and a smiley face on the WhatsApp and not on the something else? And the way we're going to model it is that we're going to say that these assets fundamentally are going to be demanded differently than the traditional assets that we have been demanded. And there is a lot of sort of thinking that goes into that. And what we're going to propose is something called a crypto app. So a crypto app is actually going to be an app that exists, that agents interact with. And in the crypto app, we're going to stimulate interaction in terms of adoption and expected returns. We're going to have a formula. And the way we think about it is that think of it as internet dating. So you're going to have it's actually, there have been papers already come out that dating decisions done on online dating, digital dating protocols are fundamentally different than dating decisions done in person. And so you choose, you swipe left, you swipe right, and men lie about their height and women lie about their weight. And so the digital representation of assets is not necessarily sort of the same as a physical. So what's a crypto app? And we call it Cinder. And so on Cinder, you're going to have a supply of assets on the F. So that F is security and stability, right, for I assets. And then the important part, and that's the part that went into that, is that there will be agents, there will be investors, and they will have risk settings that they could preset into the crypto app, the same as you're going to say, in the online dating thing, what kind of features you're looking for. And the app is going to accumulate this information. And it's going to make recommendations to you about the binary choice. It's going to present to you two crypto assets at the same time, and you need to swipe left to right on one of them. And so all of our agents are going to be doing that. There are very interesting things that I'm bumping into here in terms of these choices. We have very, very fundamental axiomatic sort of principles in economics from the 30s with Hayek, and then 60s and 70s with sort of more formal Hayek and Arrow. And I'm bumping straight into those preferences here, and I'm deliberately not even mentioning it here to you, but I'm aware of them. So don't think of me as not being aware. I'm classically trained here just down the river at the University of Pennsylvania, so I'm familiar with these things. So this is how our assets are going to be adopted. Those betas are the preferences, and our agents are going to be selecting left to right. And so what we're going to do is we're going to simulate this. I can't really play it for you. There's actually a little player underneath it. But the important part is that we could simulate for you, if we set those preference parameters on security, stability, and total return as one. Basically, they have equal weightings. We get 4 different types, 4 different clusters of crypto assets emerging. And so think of it as, WhatsApp, Viber, Telegram, and another, Facebook Messenger that you're using. If we change investor preferences, we can get to different types of, so if we change along those beta dimensions, we can get you to 2 clusters, where you only have 2 types of crypto assets out there. We can get you to, and that's basically central bank digital currencies and crypto tokens, and nothing in between. The very, very secure ones and the very, very risky ones. We can get you to 3, where you're going to have central bank digital currencies. All of these bumps indicate this is probability of adoption, this is expected return. So when you see things bubbling up, that's sort of the number. We can get you to 4, we can get you to 1, the one in the middle, right? So when we set parameters, we can change the ecosystem, we can look at different types of investors, and in summary, what I'd like to do is what we wanted to do here is to be a little bit provocative. We wanted to present something that would start making us think about these assets as being different, think about the framework as being potentially different, and maybe there is a way, maybe new economics is needed for that, and think about the new economics, and maybe the existing economics that we have is sufficient, and we just need to build on that. Thank you.
Thank you, Andrei. Andreas Park from Toronto is discussed.
All right. So thank you for having me here. So look, this paper is in an important area where we're trying to understand what these new crypto assets are. So as Itay, when Itay tries to classify the different papers that exist, I would say that this paper is essentially at the intersection between the third and the second area. In this following sense is if we want to understand, how to evaluate, crypto assets, how they fit into asset price, we need to first understand what they're doing. Now, my personal take is if we look at many crypto assets, not all, but many of them, is I think there's three things that people have been getting wrong so far, and not everybody, but that people commonly get wrong when they think about them. Number one is to say that crypto entities, so the entities that issued these crypto assets are traditional firms. They can be, but oftentimes they're not. They have foundational structures. They issue something for a platform where you just hope that something will be developed. It is really difficult to figure out what actually the entity is that issues that. Then the second thing is that we're used to using prices in markets as an assessment of the value of it, right? So this is, we're all trained that way, at least in finance and economics, is we look at a market, we look at there's a process by which demand and supply is met, and then we take this price as some efficient outcome. And that's just not true, right? Because I've done this, and for my class to demonstrate it in my classes, I issue my own token, and then I trade this token with myself to show people that the asset I've just created, which is absolutely anchored in nothing, is worth millions of dollars. And so everybody can do that. You can't just rely on whatever price there is. It's just what CoinMarketCap tells you is happening is, I don't know, is it true or not? I don't know. So I think we have to treat that differently. And then finally, also just to think about that these crypto assets are like traditional securities is also often a fallacy because they may have features to it which are just different from debt and equity, and I'm going to go into a few details of how we should think about them. And this is, particularly this last part is something where Andrei's paper rests upon. So now the first thing is to ask the question of what is a crypto asset? And I think the first step is to ask about the technology. So, you ask questions such as, what is the security of this asset? Is it hackable? Is it, can you steal it? Can you transfer it? What is it doing? Then, if you think of cryptocurrency, what's the throughput? How often can I use it given the technology that it rests upon? What is the functionality of this asset? Because, we think of an asset like as a share or, as a stock certificate that just lives on a different interface, but that's not necessarily true. These assets that are issued can actually have features of themselves and functionality that can be unlocked by doing something with it. So it's a little difficult. I know I'm making a very squishy point here, but you can program assets in many different ways and have programmable features of them. And then there's a question of compatibility. Can I use it on a different platform with different things? There's many questions that you can ask. Now the next question is obviously most of you are regulators or loosely come from the regulatory space, and you ask yourself, well, there's also legal questions, there's accounting questions, there's economic questions. Now, I would argue in some degree this is actually not a question of whether or not something is a crypto asset. Then we're just going back to the standard format of what is an asset, right? So what are the legal features of it? What are the control rights? What's the governance? What property and ownership rights does it assign? Is there any accountability for the usage of this asset and for cash flows maybe that pertain to it? Then there's going to cash flows, there's accounting questions. So is there cash flows that underlie this asset? Are there any contingencies involved? And then finally, for me personally, I think the most interesting thing are the economic features of it. Are there state-dependent utility? Does it give me anything when I buy this asset? Are there incentives? Does it particularly create incentives for people? Does it create externalities? So those are the questions that we, as particularly the last part, these are the questions that we ask whenever we think of any asset that we may or may not want to invest in. Now, this particular paper focuses on two features of this whole long list that I brought up there, which is the security, and I would call it, Andrei called it the stability, I would call it the governance of it. So now what he then did is he went out and said, okay, look, we can classify these assets on these two different dimensions, and I want to just go very briefly through the classification, and this is a little bit nitpicking in terms of what the paper is talking about, but I thought it's an important point to have with this particular audience, which is to say, how do we interpret even the assets that we're discussing, like central bank issued digital currency, in these two dimensions of the governance, so that means is it either something which is very flaky, or is it something where I can rely on that it's being governed well? And in terms of the security of this asset, so can it be stolen easily? So we have the low dimension, which is the, in case you don't know, Mt. Gox was the first major steal or theft of Bitcoin from an exchange, to the other place, which you probably know very well here, coming that you're in front with the Fed. Then there's the question of stable coins. We've talked about them this morning. We talk about utility tokens, and then there is cryptocurrencies. So where do these fit? Now, according to Andrei, he would put the Fed coins as something which is very reliable and is very secure. He puts stable coins in something which is less secure but equally reliable. Then utility tokens is something which is flaky in terms of the governance of it, because it could change at any given moment. And the utility and the security is low. And then cryptocurrencies are very secure, but again, we can't really rely on the governance. Now, in my case, so the first thing I would say is when we think of governance, I think, and if you talk to people in the blockchain world, they really worry or are interested in questions such as, is it a centralized decision-making or decentralized? So if we look at it in those dimensions, we know that Fed coins, yes, there's very centralized decision-makings, and probably the same thing holds for stable coins. For utility tokens, I'm not so sure. I would also think that usually they are somehow, to some degree, controlled by an entity, so I would say that they are also centralized. Next thing is when we think about the security, I would argue that if a cryptocurrency, we think of it as safe, then a stable coin utility token is equally safe. Yeah? So in terms of the technology that underlies it, because they usually live on, say, the Ethereum blockchain, what is the difference between that and Ether? None. Now, I would also argue, and this is something you don't want to hear, but if I would have the Fed issue a central bank digital currency, depending on how you organize this gives you a huge target for hackers. So, whether or not this is more secure than the blockchain, as far as I know, no money has been stolen off the blockchain, so I'm not convinced yet, let's say. Now, then there's other questions that you can ask. You can ask also the questions that are being decentralized. What people in blockchain really worry about is the censorship resistance. So where censorship is easily possible, or where it is very, and it's desirable, or where it is impossible. So of course, Fed coins is something where you want to be able to censor, right? Because you don't want the money to go to bad actors, right? People you don't like I don't know, Iran or Canada. At times. But in terms of governance, of course, it's centrally governed. Cryptocurrencies, they are censorship resistance, that's a feature of them. And then the same thing, actually, you could argue holds also for stable coins and utility tokens. So this is another way how you do the classification. And I think when we think of these, and so I'm making a big point here, but the point I'm trying to make is if we think of these crypto assets, we have to think of the particular features that we have if we want to assess how useful they are as an asset. All right, there's other ways how we can do the classification, and I think I have to skip over them, so because I'm not fast enough. So very briefly, we can think about also where the underlying value of some form rests, right? Could it be off-chain or on-chain? So if it's off-chain, that could be, and I'm writing over this, is very clever of me, it'd be on the right-hand side, you have basically just standard money or standard assets that we all know of. You can have an on-chain asset, like a token that is linked to something off-chain. Thinking about that is really boring from the perspective of an academic researcher, right? Because this is really just, the old thing, just in new clothes. The other side is more interesting when we think of on-chain assets because there's many economic questions that come out there and many design questions that are important. So from a research perspective, the left-hand side is more interesting. Now I'm going to skip over this slide here, and I just want to talk very briefly about this particular paper. What Andrei proposes is you look at an app, right? So this is basically a decision-making mechanism for this section of a crypto asset. Now, let me just contrast that with traditional portfolio theory. In traditional portfolio theory, you ask, there's a person, people have utility, they buy assets because they give them something, usually some future cash flow or some insurance for something that happens in the future. I want to maximize my utility, that gives me a pricing kernel, the end. This is normally how we think about this. Here, this is done with the Cinder app, where basically you have pairwise comparisons. Now, and this is the last point I want to make. So in terms of, as an economist, what I would like to see is that if you want to do something like this is derived from primitives, so there's some form of preference or utility function, and you show me that whatever this mechanism is that you'd create is actually something which feeds into what my users want to have, so that there is, economic foundation of the outcome that we're now finally observing and the selection of crypto assets that we're predicting. I'm stopping here. Thank you.
Thank you. Okay, the last paper is Bitcoin's Fatal Flaw, the Limited Adoption Problem. Fahad is going to present it.
Okay, thank you. I'm going to open with a slightly different disclaimer, which is that this paper is joint with Kose John, who you may all know. He is our ruthless session chair, and I'm sure he'll keep me to time just as he did everybody else. It's also joint with Franz Hinsen, who's an excellent doctoral student at NYU Stern, who I'm sure Kose will make sure you're familiar with within a couple of years. So this paper is actually quite simple and straightforward on some level. The motivation starts from the idea that about 10 years ago, a little more than that, there was that white paper, now infamous white paper, posted online under the name Satoshi Nakamoto, and it proposed this system, this payment system called Bitcoin with a big B, and it offered supposedly that on this payment system, there was going to be a currency, also called Bitcoin, but with a little b, and this currency was going to be the first global decentralized digital currency. Now, since that happened, or since that event, a lot has happened. I think Bitcoin has actually basically become something familiar, at least to almost everybody, and lots and lots of papers have been written about it, even in economics and finance. But one thing that didn't happen is that Bitcoin did not achieve the lofty goal that was set out for it by its founder. It didn't even really come close. And so what we thought was that, well, maybe, despite the fact that we have all these papers that are talking about Bitcoin, there aren't really any of them that think about, well, why didn't that happen, and is there actually a structural reason? You have a lot of people who kind of don't have any time for Bitcoin whatsoever and kind of think it's some crazy niche thing and don't necessarily even know what the structure of it is. And you have a bunch of people who are frequently studying it as a relevant thing by itself. But we thought it would be worthwhile to just think about, well, is there actually a structural problem that is leading to the fact that Bitcoin has not become widely used? It is sparsely adopted. And so if there's one thing to take away from this paper, this presentation, it would be, in some sense, the main finding, which I have here quoted directly from the paper. We demonstrate that the economics of Bitcoin make limited adoption an inescapable equilibrium outcome. So we have an equilibrium model here, and within this model, we're basically going to argue that because of the way the protocol, because of the way the system is set up, you should expect limited adoption as an economic outcome. Now, why is that? Well, I do need to put some structure in place before I can get to that. So let me just give you a flavor of the channel, which the channel is actually going to be negative network effects. Now, hopefully that's a little bit surprising at the outset because Bitcoin is a payment system, and when we think about payment systems, we think about positive network effects, right? And these things can be microfounded by, for example, search costs. If Starbucks stops accepting US dollars and it's the nearest coffee shop to you, then that imposes a cost of you having to go to the next coffee shop. And so that's one of the reasons why we think these payment systems have positive network effects. But what we're going to show you here is that there's something special about Bitcoin-like systems where you can actually generate negative network effects. But as I said, I need some time to get there, so let me do some very simple blockchain 101 to kind of set it up. So when I think about a blockchain, I think about two conceptualizations. One is that it's an electronic ledger. So entries are recorded in discrete chunks, which we call blocks. And the blocks are then concatenated together into an almost temporal chain. So this is where the name blockchain comes from, in fact. And so the word block is telling you there's a discrete updating process. The word chain is telling you that there is an order. You can't just flip pages on the ledger and expect it to make sense. So that's one conceptualization. But there's another conceptualization, which is also equally true, which is that it's a distributed system. So this electronic ledger is stored across a network. Computer scientists would say network of nodes. I'm going to say network of agents. In our paper, they do have agency. And so this ledger is stored across this network, and each agent holds a copy of the ledger. And hopefully already right there, you start to get a sense of why you might get negative network effects in this setting. Because the ledger is unique. There is one ledger, but there are multiple nodes that store it. And so something that I'm not yet saying on this slide, but is true in the Bitcoin case, is that information, like updates to this ledger, actually come at random points in the network, at random times. Which means, for example, say Kose and I are the only two people in the network, for simplicity. If we agree at a moment, and then suddenly I get an update, at that instance, Kose and I necessarily disagree. And to get back to this idea of a unique ledger across which all of us agree, something needs to happen. And that's actually why in the computer science literature, one of the biggest topics on blockchain is actually consensus. It's precisely about, well, how do we actually ensure that there is a unique ledger that we all agree on, given that you're going to have inconsistencies over time. And we're not actually studying the consensus process here. That has actually been studied in a now published paper in the Review of Financial Studies. But our point is that this is going to introduce a technical constraint, which itself is going to have economic implications. That specific technical constraint is network delay, by which we just mean the time it takes to communicate across the network. So why would this be an important constraint? Well, take that example again, where Kose and I are the only two people in the network, and we had agreed, but suddenly I got an update. Well, the most generous assumption I could make is that once I tell Kose that I got an update, he will say, okay, I accept your update, and now we're back on the same page, right? So that should give you a sense of why network delay would be relevant, even under generous assumptions. But let me dig a little bit further into that. So what we're actually going to argue here is basically that Bitcoin possesses three key features that are collectively going to give you limited adoption. So one of them is the thing that I already mentioned, but it by itself is not sufficient, which is that there is this need to come to agreement, okay? A second piece a bit has to do with this idea of sort of how hard this agreement is going to be to generate. And this has to do with the property that has been sort of discussed already. The technical way of saying it is that the Bitcoin blockchain is permissionless. Now, this approximately maps to the idea that there is free entry in the network, but particularly given the first paper on the program, let me clarify what I mean here. What we're talking about is that, in principle, anybody can open up their laptop and join the Bitcoin network, and even in principle, in some probability, produce a valid block, okay? That's approximately like saying free entry, but not exactly. But the point we want to, the thing that's relevant here is that the network is permissionless. It can basically expand arbitrarily. And we will actually, the size of the network will be relevant for analysis, but it will be an endogenous equilibrium object. The third piece, I think also has been touched on actually, is that there is a supply constraint, and it is indeed an artificial supply constraint. So you heard Christine talk about SegWit, which I think you said sounds like it comes out of Lord of the Rings or something. So that was actually a case in which the supply constraint was alleviated. And actually one of the important things here is that the supply constraint is artificial, which is that it can be tuned up and down. But at a given point in time, for example, Bitcoin currently has approximately 10-minute block times. So if you think that you can only put 4 megabytes on a block, that's going to tell you that you can only get 4 megabytes worth of transactions every 10 minutes. And so we're going to argue initially that these three features, which are all in the Bitcoin protocol, are going to generate limited adoption in equilibrium. So how does that work exactly? Well, so as we said, Bitcoin imposes an artificial supply constraint. And so what happens when you have a supply constraint and you have a demand shock is that quantities are fixed and prices must respond. And as has already been discussed, this is sort of a queuing game where you have people paying to wait less. They pay fees so that they can jump the line. And so specifically what we're talking about is that when you have demand shocks, the price you pay for waiting is going to endogenously go up. Now, what does that do? Well, who gets the fee? The person who gets the fee is these miners, these validators who are putting the blocks on the blockchain. So in my example, it would be me or Kose. But the point is that if there's more fees to be had, and if anybody can just join the network and mine the next block, then that creates an economic incentive for somebody else to open up their computer and to start mining it. And by the way, note when we talk about mining pools and so on, in this context, it does not matter whether it's actually a separate person or whether it's one mining pool that decides they want to increase processing power by adding a machine, okay? But the point is that when you have a demand shock, because quantities are fixed, you get that price increase, and that price increase is going to incentivize basically more processing power coming online. Okay, but when you have more processing power coming online, that is more computers, irrespective of who owns them, in this particular network topology, it is going to be the case that it's going to protract the consensus process. And the problem is that the person who's paying, the people who are trying to get on the blockchain have to wait for that consensus process to converge. And so they end up actually waiting more, and because it's a payment system, this causes them to basically abandon usage. So kind of one implicit point here is that we're talking about a payment system, not like a smart contracts platform, and with payment systems, the service is speed. You use Visa because it's fast. If you went to Starbucks and they told you when you swipe your card to come back in 5 hours for your cup of coffee, you might use cash, right? So the basic point here you can kind of summarize by saying if you have fixed supply, free entry, and consensus, that collectively is going to generate limited adoption. Now, the truth is that this, so as a start, you might look at it and say, well, okay, can you alleviate the problem? That's a natural thing to say. This consensus thing, you really can't unless you want to get rid of the using a blockchain. And free entry, or at least really permissionlessness, was very core to the way Nakamoto thought about this stuff. And Andreas was using the term decentralized and so on. This is, again, very sort of philosophically hard to overlook, although we actually do in the paper look at permission blockchains that relax it. But if you kind of want to keep Nakamoto's vision, you have to keep these two. And the only thing you can really do is play with this supply constraint. And that actually is kind of the intuitive thing to do, because this is actually not that different of a problem than we incur in traditional situations. And so to make that point, let me just give you an analogy. If you go to a grocery store and suddenly a lot of people want to check out, it's true, all things equal, this would cause elongated waits, and maybe people would start leaving the grocery store because they don't want to wait 2 hours to check out. But that's not actually what's going to happen in that setting, because what's probably going to happen in that setting is the grocery store is going to open up more cashiers. They will expand supply to meet the demand. And so there's an analogous case here. You could imagine expanding supply on the blockchain to meet demand. And in this context, what that would map to is to let block times vary with demand. So to speed up the rate at which blocks come on the blockchain when demand goes up. And indeed, from a technical perspective, this is not actually a difficult thing to do. So why not do it? Well, it turns out that this solution will actually only succeed insofar as it causes centralization. Arbitrarily fast block times will actually cause delays to diverge, so it ends up being self-defeating. Now, why is that? Well, let me take you back to the grocery store analogy. So the grocery store is going to open up more cashiers to process this heightened demand. The difference between the blockchain setting and the grocery store setting is that the grocery store cashiers are doing parallel processing. They do not have to ensure that there is a unique order that everybody agrees on for the people that were processed. The blockchain does. So in the analogy, if you imagine it and more people start joining this network, so Itay starts mining all of a sudden because of this demand shock, if it takes me 2 seconds to communicate to both Kose and Itay, and they process 5 people in that time, the order they see is different than the order that I see. And this needs to be reconciled. And until it's reconciled, you have basically chaos on the blockchain. So that's a very key difference between the grocery store analogy and the blockchain. In effect, decentralization actually has this cost, which is you need to be able to reconcile what's going on. Now, one solution which we discuss in the paper is a public permission blockchain, which actually relaxes the sort of permissionless aspect. And I think it's particularly germane given what Libra is doing. And Itay mentioned maybe there's no lack of work in blockchain, but I would ask for the people who actually watch the Libra hearings whether they think that it might be useful for economists to provide some context on this setting. because frankly, I don't know, I don't know that this has been studied so far. But I won't really have time to dig into this. So instead, what I'm going to do is I want to just give some context on a part of the model to kind of highlight why what we do is different than what's already been done in the literature. So the first thing you have to understand is kind of how mining sort of works. And Nakamoto had this idea that he didn't want mining to be favorable to any particular person. And so what was set up is that to actually produce a block on the blockchain, you basically need to solve a trivial puzzle. And it really needs to be trivial because you don't want to give comparative advantages to people who are, for example, smarter even in this context. And the process by which puzzles are solved on the Bitcoin protocol essentially are equivalent to coin flips, to Bernoulli trials. So it would be like if I have a coin and I'm sitting here and flipping it, and if it comes up heads, then I get to say, I've created a block. Okay? That's basically all that mining actually is. And it turns out that this is, of course, one of the best studied processes in particularly queuing theory, and a particularly relevant result here is something called the Poisson limit theorem, which loosely speaking says that if in a short period of time you do a lot of coin flips, and the likelihood each coin flip succeeds is very, very low, then the distribution of actual successes is approximately Poisson, which gives rise to the Poisson process, which is the typical assumption that people make when they model this stuff, when they model the Bitcoin blockchain. We're going to do something very close. And the reason it's very close and not exact is that this actually makes sense really only if you're thinking about an individual miner. Which is to say, it's true if I'm sitting here flipping coins and I'm doing it at light speed with very low likelihood of actually coming up successfully, that the process, the number of successes I have will look like a Poisson process. But what happens when you go to just me doing it to adding in Kose and Itay? And the answer is that implicitly what papers tend to assume is that there's no network delay, that I'm able to immediately transmit information. Because the question essentially is that how many solutions were discovered, say, across both me and Kose? Well, people will essentially assume that it's just the number that I had plus the number that Kose had. Which then would say that you can aggregate and you would get a Poisson process, but that's not actually true in this context. And I'll give you a simple example here to clarify why that would not be the case. So consider a single sample path of me and Kose sitting there flipping coins. If I suddenly get a head 1 second in, or rather a success 1 second in, and Kose gets a success 2 seconds later, but it takes me 5 seconds to communicate that to Kose, if you were assuming that we just jointly have this process, you would think that we have found 2 blocks, that we have 2 valid solutions. But the truth is, because Kose didn't know that I had a valid solution at the time that he got his solution, our 2 blocks are actually going to be internally inconsistent with each other, and they cannot simultaneously end up on the blockchain. And so basically, we're going to put this feature into our analysis. And it turns out, actually, if you look at the literature, this sort of disagreement, that is these forks on the blockchain, quantitatively, the vast majority of them are actually these sorts of disagreements. They're not incentive-driven disagreements that initially arise. They are actually these network delay-based disagreements, and they have not been studied in the economics literature to this point. And while you could say, well, that's a technical thing, well, the point is it's actually not a technical thing from the perspective of the user side, because this is a technical limitation that is completely ignored by the economics literature that we show has an important economic implication for whether users actually want to use the system. Now, let me quickly offer some context about why, about how this relates to the actual results. So basically, you can show that the likelihood disagreement arises is actually decreasing, not only in the network delay, the time it takes to pass information across the network, but also the speed at which the blockchain processes transactions. And essentially what's happening there is basically that because Kose and I are flipping the same type of coin, in order to speed up the blockchain, you must make it more likely that each of us can actually generate a success. But at the moment that one of us gets a success, you suddenly want the other one to stop getting successes, because you don't want that other person to find a success until they hear about the previous success. But you cannot turn that lever off, precisely because Nakamoto envisioned that it has to be egalitarian in this sense. His puzzle has to be the same as my puzzle. He can't have a coin that's better than my coin and vice versa. So when you speed up the blockchain to absorb that demand, you essentially get this self-defeating aspect, which is that, yeah, you sped it up and people are getting solutions more, but they can't converge on anything because the information is not moving fast enough relative to how quickly they're actually solving this thing, right? So essentially what this then tells you is that if you want to scale this stuff and you want to try to if you want to scale this stuff, you either have to leave the block rates really slow, in which case you'll have the case that you have now, which is it takes too long to get on the blockchain and you have to pay too much to get on the blockchain, or you try to speed it up and you'll have pure chaos because they will never be able to converge on anything. And that is how, essentially, you get limited adoption. And I'm being ruthlessly told to sit down now by my co-author. So I will do that. Thank you.
Thank you, Fahad. Katya Malinova from McMaster is going to discuss the paper.
Thank you very much for having me here. I just need to find my slides somewhere. So Fahad did a very good job presenting this and talking about this. And when I started reading it says the Bitcoin fatal flaw, the limited adoption problem. But I think the message of the paper is actually much more general, even though they talk about the Bitcoin and they talk about the proof of work. But what you're saying is there are limits to decentralization. There are physical limits, physical capacities. So we're talking about decentralizations, platforms, whatever we pass. It's not just about the Bitcoin. It's just that the model is about the Bitcoin. But we're going to have limits. We're going to have to look into centralized solution. And I think this is partly what they do in the paper as well. Now, in terms of the paper itself, the authors look at the blockchain as a payment infrastructure. And they first show that Bitcoin, or the proof of work protocol, is just not scalable. And so, in fact, not only it's not scalable, and this is the part where Fahad didn't get to, but in fact, the fraction of users that use the blockchain vanishes as there are more and more users that are interested in blockchain. And this is the part that is surprising to me, and I'll return to this point. And then they say that, well, if there are limits to decentralization, what are the alternatives? Well, the alternatives are a permission system. And so when there is a permission system, again, not all, we still need a consensus mechanism, even though there is a permission for the validators to be there, and not all of them work. And so they propose one particular one that does work. So what I'll do is I'll talk a little bit about the model, and I think I'll talk about the parts that Fahad just skipped in his presentation. And so we first have the users for the proof of work. And there are end users that need to transact. And these end users can choose to go to the blockchain, or they can choose to go to the traditional payment system. If they go to the blockchain, they have a certain reward from using the blockchain services. They have to pay a fee to the miners. We're assuming the miners get no other money other than from the fees. And there is an extra cost. I want to be done with my transaction right now, but I have to wait. And as users, we're heterogeneous with respect to waiting, so depending on how patient or impatient we are, we sort of place a certain value on the time that it takes to confirm the transaction. And then some users just don't want to be there. And also, all these users have a choice to go to the traditional payment system, which is left unmodeled and basically normalized to that being a zero cost and zero reward. You could always go there. So if you have a positive benefit from being on the blockchain, you're going to go to the blockchain. The second component to the model is the validators. And in the main sort of portion of the paper, when they talk about the Bitcoin protocol, this part remains unmodeled, and they assume to coordinate and don't behave maliciously, as far as I understood. And there is a free entry condition, which determines the number of these validators. So what the free entry condition says is we're going to enter as long as our number is going to be the total profits that we're going to make in from the fees, the validators, divided by the cost of entry, because you have to acquire validation technology. And so this particular equation is going to come back up. And again, I have somewhat of a question about this later on. So what happens? Well, in equilibrium, we have a bunch of users, and they differ in terms of how patient they are. and we're going to have to wait. So we're going to have a marginal user, somebody who's willing to use the blockchain. So if I'm really, really impatient, I'm just going to go to use the Visa card. And if I'm patient enough, sort of with low impatience, I'm going to use the blockchain. And the marginal user is going to pay a fee which depends on two components. First is how fast is block size arrival, or not the fee, but the marginal user is going to wait for sort of two reasons. One is the blocks only arrive every 10 minutes, so you can't get my transaction processed really fast. And the second one is, this is the part that Fahad talked about quite a bit, is the fork dispute resolution time. So we have to communicate, we have to agree on the blockchain. And so as it turns out, this is the problem. The network delay is the problem. And as the number of users that are potentially interested in the blockchain increases and explodes, so does the waiting time. It's just going to become infinitely long until my transaction is confirmed on the blockchain. So I'm never going to get that coffee that I so desperately need right now. And that's what they term limited adoption. So what happens in the limit? Well, if I'm never going to get that coffee, I have to be really fanatical about using the blockchain and infinitely impatient. And so the limited adoption is not just that there's a fixed fraction that adopts, but the fraction vanishes as more and more of us become interested. And so why does that happen? Well, so the key result in the paper is that as the number of users interested in blockchain increases, explodes, so is the number of validators. And because the number of validators explodes, well, there are physical limits. Like, it takes time for us to communicate, and there is just, how do you make sure an infinite number of people agree? Oh, that's not going to happen. So I have to say, I think that's actually a key result of the paper. I was a little surprised to find it in the appendix. So I would, like, as a side comment, move it up. But the question I have is, why does it explode? And my intuition would have been that actually, sure, there are physical limits, and we're going to have fixed adoption, limited adoption. But for everything to vanish and for number of validators to explode, I'm a little bit surprised. And so I went back to the free entry condition. And so what happens is, well, the cost of entry, the technology cost, is fixed. But the number of users explodes, and so the expected fees that these users are going to pay explodes as well. My first comment, which I'm going to somewhat skip, but basically I would like to have a little bit more intuition. How come the fraction of people that pay these fees vanishes, and yet the total fees that they pay explodes? I'd like to know if it's a modeling choice or something. But my second comment is sort of, what I don't understand is, if I never get to pay for my coffee, why would Starbucks continue to produce this coffee, in a sense? So if I never get to pay the fees, the validation time, the confirmation time go to infinity. But my understanding is that the fees are only going to be received after the transactions are processed. So if transactions are never confirmed, but to enter the system, I have to incur technology costs in real time, why are validators not caring for it? Why do we have infinite number of people, infinite number of validators entering? Why aren't they discounting? Is there some sort of boundary transversality condition? And so I fully agree with you that there are definitely limits to decentralization. But I would like to have a little bit more of an understanding as to why the fees are never paid, and yet the technology costs are continued to be incurred, and validators continue to enter. And even if they pay in Bitcoin, which they never have to pay, still somebody has produced the computers and so on and so forth. The second model, and I go model 2, but so, okay, this does not work. There is limited adoption. What can we do? And the authors actually go on, and I honestly think it's a second paper. They say, let's look at the permission system. And this is, Fahad didn't get to talk about it, but it seems to be somewhat of a different model. And so my comment 1 was, have one paper, one model. In the first case, you have validators, free entry, somewhat unmodeled. In the second case, the validators actually play coordination games. So it's a very different system from what I can see. You also have to have introduced and value the cryptocurrency, which is what we do. So again, it's yet another component. And in my mind, there was no clear connection between these two components. And I also didn't quite understand why you moved directly from decentralized to permission, permissionless to permission. Is there any way to sort of reduce the number of validators just from having decentralized alternatives? Maybe require minimum cryptocurrency stake for the validator to become valid, to decrease the number. My second question is, why do we even have blockchain? What is the purpose that this blockchain is solving? Particularly as we went from decentralized to permissioned. So when I'm thinking Bitcoin, I'm thinking censorship resistance, immutability, anonymity. I'm wrong, I know, but still there is something that I'm getting from it. When I go to permissioned and centralized, am I not going to lose that benefit? And where does that utility stem from? Where does it come from? And the last question is, what are the differences between the permission blockchain versus the traditional system? Because here you view the permission as an alternative to traditional. But once you go to permission, and once you say if you're permissioned, you get 100% adoption, that seems very similar to the traditional payment system. And also, I mean, conceptually, do we want 100% adoption of the blockchain network? I'm not sure if that, is it enough to have a finite? If we have 100% adoption and everybody switches to blockchain and nobody uses the US dollar anymore, is this the economy we're looking for, where we're all using Libra? So I understand these are the conceptual questions, and I'll stop here because I'm out of time. My remaining set of questions were to say, is grounded better in the, oh, actually, I'll take 5 seconds to say that one other comment I have is, when you talk about permission and cryptocurrency value, you look at it, and this is one part I do like about the paper, from the supply side, from the blockchain side. And there are also a lot of papers that talk about the limited adoption, of course, from the demand side. And we heard about it in the keynote this morning. And it would be nice to tie these two together to see which results are jointly obtained from both. Thank you very much.